Good morning and welcome to this recording. I'm talking to you this morning about Custodian Property Income REIT. And in common with all great businesses, we have a mission statement, and ours is to be the REIT of choice for private and institutional investors seeking high and stable dividends from well-diversified UK real estate. And that, I hope, encapsulates what we're about to talk about. We're talking clearly about real estate and our particular way of accessing those high income returns from UK real estate. But let's start by considering the investment landscape, because it is far from straightforward. Now, I've said here that I think this could be the darkness before the dawn. And in many ways, the dawn for commercial real estate started last year, but the clouds moved in to block out the sun in the early part of this year, as we've had undue focus, or maybe very due focus, on geopolitical risks and the recent Trump trade war. And that has led to significant volatility, and we were exposed to that along with everyone else. I'm pleased to say that our share price is now higher than it was before the first salvo of the Trump trade war. But there remains uncertainty in the economy. The November 24 budget led to a great deal of uncertainty, which persists. And we have had plenty of competing investments which have drawn the fire of investors, most particularly in fixed income. The environment for real estate has been tough since 2022, when we started to see those rapidly rising interest rates, which is very bad for real estate, and that led directly to falling valuations. There has, over the period since late 22, been a big focus on the macroeconomic drivers. And I think more recently, that has meant that people have overlooked the positivity in underlying real estate. But I think we're now poised for a sustained recovery. So what are the prospects for listed real estate? And is the pendulum about to swing? So I've set out here the reasons to be optimistic and some of the challenges we face. And I'm pleased to say there are more reasons to be optimistic, but you might argue some of the challenges fall more heavily. So the geopolitical challenges we've talked about, it's led to uncertainty and volatility. The stalled growth agenda in our own economy, again, we've discussed. The 10-year gilt rate has been running pretty hot, and there is a near perfect correlation between 10-year gilts and listed real estate pricing. And we felt that very keenly, but we have seen a slight easing of that over recent days. And I think perhaps the biggest challenge we've seen in the sector is the supply and demand imbalances. So institutional investors particularly are completely off real estate at the moment. Now, that's not to say the market is all about institutional investors, far from it. But they do make up a significant core of typical demand. I know this next statistic comes from the direct market rather than the listed sector, but in the last quarter, Lambert Smith Hampton recorded institutional investment at a 16-year low. So we need all the players back on the pitch if we're going to see a recovery, and we need that institutional demand for real estate to come back. And I think there's a very good reason why it should, because we've seen rising property valuations, strong rental growth now across all sectors, yes, including the office sector. Interest rates have been falling and are forecast to continue to fall. We are paying sustainable dividends, which are fully covered by earnings, and we don't see any near-term clouds on the horizon to stop that being the case. There's been a lot of corporate activity in the real estate space of late. And what's interesting to note, against a prevailing discount to net asset value across the whole of the listed sector of around 25 to 30%, most corporate deals have been done at somewhere between 0 and a 10% discount to net asset value. So there's a clear mismatch in the perception of value. Private equity money that is coming into the sector clearly sees an opportunity that the market as a whole is missing. We're seeing the risk premium to real estate much wider than the long-term average, suggestion being that that should close and trend back to a more normal risk premium over time. And the very wide discounts to net asset value, of course, are creating a really interesting income opportunity, but I fear that could be short-lived as those as those discounts narrow. So dividend yields will be squeezed. But if we look today at Custodian Property Income REIT against a dividend per share of 6p, the dividend yield is more like 7.75% because of the discount that we are sitting on. And in conclusion, I would say that the noise around the market is obscuring the clearly very positive information that should be driving demand into listed real estate. But there is no getting away from the very close correlation 10-year gilts have with listed real estate, and the FTSE EPRA UK REIT index is that benchmark index of almost all the largest UK listed real estate companies. And you can see how that correlation has played out. But with gilt yields softening a little, forecasts from earlier in the year, and I'm not aware that they've been recut, but perhaps they have, were that we could see gilt yields at around 4% by the end of 2025. Well, that would clearly be very positive for real estate, and you would expect to see a recovery in listed prices on the back of that. And the short-term view of 3-month SONIA, which is again a crucial number for listed real estate because most of us have gearing. The forecast is that we will see rates come down in the near term. And for us particularly, while most of our debt, over 80% of our debt, is fixed rate debt, we have the balance, the other 20%, sitting in a revolving credit facility, which has variable rate debt. And as SONIA comes down, so the cost of that variable rate debt falls, and that creates additional earnings headroom, which is positive for dividends. As we see interest rates fall, so we should expect to see a rotation out of what were perceived to be lower risk investments into what are perceived to be higher risk investments. And clearly real estate must have been in that bucket of perceived higher risk investments. But we would expect to see, as interest rates fall, more money rotating into listed real estate. So again, positive short-term prospects for the sector. And looking at slightly longer-term prospects, this chart is a consensus forecast, which is put together by the Investment Property Forum. The Investment Property Forum is the great and the good of the real estate world, be it investors, advisors, banks. And you can see this forecast, which was from November last year, shows very positive total return forecasts over the next 2 or even 4 years. But the common theme is the underlying income return that drives the greater part of that total return. but strong capital growth forecast. And I would hope that more of that capital growth this time round will come from rental growth rather than simply through yield compression, because that's growth that sticks. When you see rents grow and yields staying the same, then you see valuation growth that sticks for the long term. If you were to break these numbers down and look at the individual sectors to see which are going to perform more strongly, industrial and logistics remain the sector where we're likely to see the most rental growth, or so the forecast says. But retail warehousing, out of town retail or retail parks, we call them all three, is the sector where the highest total returns expected. And we've already seen strong capital value increases in retail warehousing through the early part of this year and supported by rental growth. But all sectors are showing positive growth, including offices and high street retail, albeit they're a little bit more challenged than the other two. It is still in positive territory. So let's consider Custodian Property Income REIT in a little bit more detail. But first asking the very simple question, why should I invest? And why should I invest now? I think the reasons for investing are that we run a diversified property portfolio. Of course, diversification mitigates risk. And as you've seen from the slide before, when we have a market where all sectors of the market are showing positive performance, then a diversified portfolio can really work. You, of course, have the liquidity of being in a listed fund and the tax efficiency of being a real estate investment trust. And on the left-hand chart of this wheel, I think you get into the really interesting parts. Stable income returns, the inflation hedge, and this is a question that is so often posed about real estate. Is it, in fact, a hedge against inflation? Well, we can see now, following a period of inflation, the strong rental growth that is coming through our portfolio and across the whole market. And that, of course, will increase asset values over time. And we will see that hedging effect for real. And right now, the very attractive dividend yield that you can get in the sector. So as I said, dividend yield is, well, at the time of preparing these slides, about 7.9. I think that was as at 31st of March. But as at today, more like 7.75%. That's fully covered. And of course, sitting at a discount as we are, that offers upside as that discount is closed. So I think the timing is also very interesting. Now, what sets Custodian Property Income REIT apart from its peer group funds? Now, I'm not the sort of asset manager that likes to claim we have a unique opportunity, but what we do, which others don't do, is focus on smaller regional properties and try and provide access to that diversified regional UK commercial real estate, but in an institutional grade package. By buying smaller properties, we have a large portfolio of 151 properties, over 300 tenancies, supporting that dividend of 6.6 pence per share, and with real rental growth potential. And you can see on the right-hand side of this slide, the reversionary potential against a passing rent, that's the rent we're collecting today, of 44 million, and an estimated rental value of 50 million. There's a 14% upside potential to come through as we settle rent reviews, grant new leases, and let up vacant space. Just looking at some news from the last quarter, I think headlines are, it's been good news across the board. Like-for-like valuation growth of 1.5%. That's 2.4% for the year, but you can see that pace of growth picking up through the latter part of the year. And importantly, that rental growth was supported by 1.5% rental value growth and over 5% for the year. We saw 17 new lettings during the period, and post-period end, 3 new lettings. And just to look at some of those in the industrial and logistics sector, Romac Distribution and DHL both signed up to new 10-year leases at 30 and 33% ahead of the previous passing rent. And Positive Planet took offices that we had refurbished in central Manchester at 80% higher rent than the previous rent. So that rent went from £20 a square foot pre-refurbishment to £36 a square foot today. Rental growth was falling in through settling rent reviews. 2 rent reviews agreed 31% ahead of previous rent. And at lease renewal, 9 renewals, rents 13% up on the previous rent, and importantly, 11% premium to our valuer's estimate of rental value. And that's not to say the valuers got it wrong, because in estimating rental value, you have to look backwards at deals that have been done. But of course, in a growing market, we're looking forwards at deals that we can agree and that will set the rent for the next 5 years. So if you go back to the previous slide where we said there was a 14% reversion, that could be somewhat higher as we actually settle those new leases. And we have recorded £100,000 worth of income from 10 solar arrays that we have installed across the portfolio in the last quarter. We have another 12 sites that we are in progress of installing solar. So a useful additional income stream. Net asset value growth has been positive, 1.8% up in the quarter to take us to 96.1 pence per share. We sold 2 offices. We had been selling out of town offices. We sold those ahead of valuation. And all of this has led to a quarterly NAV total return of 3.4%. Looking at some of the numbers in a bit more detail, and perhaps looking first at the chart. This chart looks at that rental growth potential that I think is so important. The light blue line shows the reversionary potential, the difference between the passing rent and the full estimated rental value of the portfolio. And you can see how that rental growth really started to build into the portfolio from 2020. The line the blue line falling isn't suggesting that there's a problem, but it's suggesting that some of that rental growth we've picked up. And you can see that in the blue bars, how the rent roll for the portfolio has grown over time. Now, you might notice that as at March 25, that rent roll had fallen a little bit. This is just a peculiarity of timing. We had 3 leases that came to an end, or properties where tenants have moved on, but all 3 of those have post-period end either got terms agreed or the deal has in fact exchanged. So we expect to see rent roll pick up to reflect those new lettings. Occupancy, it's more of the same story, really. It dropped to 91.1%, but on the back of those new lettings should be back up at 93%. And through the period, we have managed to bring our loan to value down to 27.1%. It peaked at a little over 30, 29% this time last year. And bringing that gearing down has been accretive to earnings, because we have brought down the quantum of variable rate debt, which, as I said before, was that relatively more expensive tranche of debt. Our portfolio is, as I said at the start, diversified, and it's diversified because diversification mitigates risk, but we are not evenly diversified across the sectors. We are our income is split, as you can see here, 41% from industrial and logistics, 22% from retail warehousing, and the other numbers you can see for yourself. Why are we split this way? We're split this way because we believe that industrial, logistics, and retail warehousing show the greatest prospects for rental growth, and that is our key focus. But we are also seeing, and we touched on it before, good rental growth in the office sector, and from the unhelpfully labelled other sector, so particularly things like drive-through coffee shops, strong rental growth in that sector, and even seeing some rental growth on the high street. The next two slides really look at diversification, and I think the map tells a pretty clear story that the income is spread across the UK, but in the principal commercial centres and following the main arterial routes of the country, central belt of Scotland, the northwest, the Midlands, and a smattering across the southeast and southwest. What we're really looking for is those commercial hotspots in regional economies. And for those of you listening, you will all know those that are particularly close to you. And this slide really tells the full story on diversification. What it's demonstrating is the amount of income that is paid by any one tenant in the portfolio. And amongst our largest tenants, Menzies and Wickes, we have multiple properties. So 8 let to Menzies, 3 or 4 let to Wickes, 3 or 4 let to B&M Bargains. So within those larger slices of the pie, there is further diversification, which means that there is no one property let to any single tenant that represents more than 1.5% of the rent roll. And that's genuine risk mitigation. One of the challenges that is sometimes levelled at our strategy is that surely if we've got all these small properties, we must have lower quality tenants. And that simply isn't the case. High quality tenants need smaller properties just as they need larger, particularly in regional markets. And those are the sort of occupiers that we particularly favour. But by reference to an Experian credit rating, you can see here that 84% of our tenants are considered lower than average risk by reference to that credit rating. So what have we got? We've got good quality income, well diversified in good modern property, spread across the UK, supporting growing earnings, which pays a fully covered dividend. It's a pretty heady mix, I would suggest. And you can see here how in the light blue, our earnings have always fully covered. In the dark blue, our dividend. Now, the question that you should rightly ask is what happened in 2020-21? Well, of course, we all remember what happened. The global pandemic was particularly interesting time to be managing a real estate portfolio, because one of the first bits of legislation that was enacted was that tenants didn't need to pay their rent in that given year. They weren't excused the rent, but they could delay payment of that rent. Now, we didn't know how long this was going to continue. So we moved from paying our dividends out of earnings to paying our dividends out of cash collection. Now, as it turned out, in that year, we collected 92% of the rent that was due, and the vast majority we collected after the event on payment plans. Our tenants were very good at standing by their obligations. And the expectation was that we would increase the dividend once life returned to normal. But of course, as normality started to return, in 2022, we saw the rapid increase in interest rates. And that was, of course, a hit to earnings. And therefore, we weren't able to put the dividend back to where it was pre-COVID and when interest rates were nearly zero. But we have been able to grow the dividend nearly every year since 2021 to show a compound growth rate of 4.6% since that low point. Why do we do what we do? Why can we be bothered to build a portfolio of 150 smaller properties and take on the management that comes with that? And the answer is income. And this chart, I hope, explains the rationale behind that. What it's looking at is whole market data going back to 2000. It's showing the net initial yield or the transaction yield of properties that have traded with a lot size of over 10 million, represented by the light blue line, and under 10 million, represented by the dark blue line. Why have we chosen 10 million? 10 million is broadly considered the sort of de minimis value threshold for institutional investors. Very few institutional investors will buy properties below 10 million. And while they're not the whole market, as I said before, they are a significant constituent part of the market. They really can move market pricing. So what have we seen? From 2000 to 2010, a very narrow and consistent margin of about 65 basis points. And some would say, well, that's the risk premium, isn't it? And I'm prepared to accept that some of that's the risk premium. And let's keep the math simple. Let's say of that 65 basis points, 50 basis points is risk premium, and the balance is I can't be bothered to manage a portfolio of smaller properties if I could have a simpler portfolio of larger assets. So we got a 50 basis point risk premium. So what happened in 2010? Did we see the risk profile of smaller properties change versus large ones? Of course, we didn't. Nothing changed to reflect risk. What we're seeing is a change in supply and demand characteristics of the market. We saw much greater demand for relatively large, relatively prime assets, partly, of course, driven by the very low cost of debt, which meant they were affordable to a wider range of buyers, but also because there was a desire to get more bang for your buck from managing lease events. And if you're managing a £1 million rent review, then it's clearly more rewarding than one for £100,000. So we've seen asset management teams shrink and focus on smaller portfolios of larger assets. And all of this has created a risk premium, a margin of 150 basis points. Yet the risk premium, I would maintain, is still only 50 basis points. So I think that we can deduce from that we, by buying those smaller properties, are getting 100 basis points of additional return for taking no additional risk. That additional return allows us to pay a higher dividend. It's dividends and income that make up 75 to 80% of total return from real estate, and therefore makes complete sense to us to focus on that sector. And we've also been rewarded with lower volatility in pricing. So through the 3 years to the end of 2024, the volatility in that light blue line, in those larger lot sizes, was 29% versus only 15% for smaller lot sizes. So two good reasons why that smaller regional property strategy, I think, works. One of the side benefits of a higher income strategy is that we are more resilient to the increasing cost of debt. And I think while we might see some short-term falls in interest rates, I don't think we're going to see a return to the near zero interest rates that we had. And indeed, we shouldn't wish for that, because it means there's something fundamentally wrong with the economy if we have to rely on such low interest rates. So in a relatively higher interest rate environment, and what this chart is showing is our weighted average cost of debt, shown by the grey shading, and you can see how that increased from 2022, that the small proportion of our variable rate debt increasing costs. It's taken our weighted average cost of debt up to 4%, but more recently reduced to 3.9%, and it's been reduced through the profitable sale of a number of properties, paying down our variable rate debt, and reducing our exposure to that relatively higher proportion of debt that is subject to those higher interest rates. And then we've set that variable, weighted average cost of debt against, in light blue, the net initial yield from the portfolio, and in dark blue, that reversionary potential. And you can see we're still maintaining a very comfortable margin over the cost of debt, and one of the other supporting factors of our smaller lot strategy. Talking about debt, you can see in the chart on the left the 4 tranches of debt we have. The 2 larger tranches of debt are both fixed rate, fixed till 2028 and 2032. We have a revolving credit facility and a £20 million facility with SWIP, which expires this summer. The expectation is that that will be absorbed into our revolving credit facility in the short term, while we wait to see whether fixed rate debt comes down as the short-term rate falls, which is probably what we would expect. So sitting today, loan to value of 27.1%, weighted average cost of debt of 3.9, and 80% of our debt is fixed rate, and that provides minimal refinance risk. We've never benchmarked Custodian Property Income REIT. We feel that absolute returns are more important, and most particularly income returns. But after 10 years of trading, we did look back just to see whether our strategy had worked. And this chart looks at share price total return from IPO, and it's charted against the benchmark, that FTSE EPRA NAREIT index. And you can see that Custodian has outperformed. How has it outperformed? It's outperformed because, despite what anyone might tell you about the property market, we all operate in the same market. We are all exposed to the same macroeconomic factors, the same interest rate drivers, and fundamentally the same pool of demand. So no one in the market has seen any explicit performance just through yield compression, putting stock selection to one side. Clearly, if you'd gone all out in the hottest sector, you would have outperformed. But for diversified funds, no one has seen an explicit growth just through yield compression. And each and every year, we've paid a higher dividend than the peer group average, certainly than the FTSE EPRA REIT index average. And it's that higher income return that has led to the long-term outperformance. So in conclusion, income and income growth are going to underpin returns. I would hope that capital growth is pegged very closely to income growth, and we don't see too much yield compression. That's not really very healthy. While it might be quite exciting in the short term, it just creates volatility. Falling interest rates are forecast. The 10-year gilt rate is expected to fall. Both of those should be good for earnings and for stock prices, respectively. The direct market has already turned, and we're seeing that valuation growth. Yet the listed sector is lagging behind. So the window of opportunity to buy into a market with significant pricing buffers as a result of the discount to net asset value and high dividends, giving you a great entry point into a recovering market, could be short. So I think the time to invest is now. Many thanks.